Good morning, ladies and gentlemen, and welcome to our first tax chat for 2023. We didn't have a tax chat in January, but we did have a budget event in February, and before we see it, we're already in April. But welcome, and I hope that you will enjoy today. I am speaking to you from the sunny Mossel Bay. So I've put my headphones on so that the sound is much better. But I hope that you have some fun this morning. We've just got an hour session, and I thought about talking about two very, very important things that's happened in the last 3 months, since about November. So it's a bit more than three months. There's been some interesting case law, apologies, on understatement penalties. 3 cases, High Court case and 2 Supreme Court of Appeal cases. And I'd like to go through that because that has changed the playing field insofar as understatement penalties is concerned. Then there were new dispute resolution rules that were published. Not a lot of changes, but I thought it would be appropriate for us to just go through those dispute resolution rules because we seldom do that. We seldom go through the rules. We just go through the motions. We do objections. We do requests for reasons, and I thought let us just go through it and then see what is new and what we should do and what we shouldn't do. So welcome for the next hour. So just a bit of introduction. the Creston Pretoria team that we introduce to you every time. We've got a very wide range of specialisms that we do and very experienced partners led extremely capably by Heinrich Moller, and we look forward to hearing from you. If you want advice, anything from a merger and acquisition to an audit to financial statement preparation work to evaluations, we've got you covered. And then we're very pleased to announce that Nick van Niekerk has joined us. I've known Nick for close to 30 years. He was a partner with me at KPMG in a previous life. He was an audit partner at KPMG. We audit large listed companies, and now is focusing on the advisory side of that. But he brings a wealth of experience to Creston, and we really look forward to working with him in Creston, South Africa. You can go through our capabilities. We've just been announced that Creston globally is again the 13th largest accounting network in the world with 23,000 professionals, but I think what sets us apart is our footprint is extremely large, where the big 4 firms concentrate on just the main centra. We are present in also the smaller centra. In South Africa, our footprint is through Bloemfontein, Cape Town, Elizabeth, Northwest Province. So we're across the country, and we're literally a phone call away. So we don't believe in faceless consulting. And that is why it's always better for us to meet with our clients in person, because then we can truly give you proper advice. And this is our global footprint. Last year, well, it's already 2 years ago, we celebrated our 50th anniversary, and across the globe with 160 member firms, over 750 offices, and as I said, the 13th largest organization of this nature in the world. A little bit about myself, but I think I've bored you enough about myself and Creston. So let's go back to some of these interesting case laws. Now, this is the first one I want to talk about. It is the Thistle Trust case. It is a Supreme Court of Appeal case. So that's the highest court before you get to the Constitutional Court. So what has happened there? This deals with a highly complex matter. And the matter is when you deal with multiple trusts. So as you know, Section 25B of the Income Tax Act is if you have a trust and that trust receives dividends and it declares the dividends onto a recipient, irrespective of who that recipient is, it retains its nature as a dividend, provided that you declare it in the same financial year. So trust generally has got a February year end. So if you receive a dividend in the February year end, you undeclare it, you vest it in the name of beneficiary. In the hands of beneficiary, it retains its nature as a dividend. The same with rental income, the same with interest income, the same with trading income. So logic tells you that's the way a trust works. And the logic tells you that surely that should also work for capital gains tax. But obviously capital gains tax, it's still it's still the income tax. It's governed by the Income Tax Act. It's just a schedule, the 8th schedule in the Income Tax Act. And but your logic tells you that if a trust receives a capital gain and then it vests that capital gain in its beneficiary, then it would retain its nature as well. And this is what the Thistle Trust was about. So there were multiple trusts, and the Thistle Trust was receiving a capital gain from another trust, but it's a single trust. And it then vested it, and again in its beneficiaries. So the question is that how long do you get this? Does it retain its nature as a capital gain? So SARS said, no, it's only once. So when the trust receives it, you can do it once, and then you've got to tax it as a capital gain. And the taxpayer believed that it will retain its nature even if it goes through multiple trusts. So the taxpayer actually won the special court case. They won it, and the special court said, no, it retains its nature as a capital gain straight through. The appeal court then looked at it, and they said, no, it doesn't retain its nature. It's only once as a capital gain, and then you must tax yourself as a capital gain. So this is technically a watershed case insofar as the vesting of capital gains is concerned. You can only vest it once. Thereafter, it changes its nature. So if you've got a multiple trust structure, you have to see whether you can unwind it in some manner if there are capital gains that's coming through these things. But today we're not talking about that. But as you can see, it's technically a very complex matter. And the taxpayer won it in the special court case. So there were two issues that were considered in the appeal court. Firstly is the technical case. Technically, will it retain its nature as a capital gain, or will it not? Will it just need to be taxed? And the second one was the imposition of an understatement penalty. Now, as you know, understatement penalties is charged in terms of the understatement penalty table. 10% is a substantial understatement, and that is generally R1 million or 10%, 5% of your turnover. And then you get to no reasonable care in preparing the tax return, that's 25%. And then 50% is when there's no reasonable grounds for tax position taken. So SARS, in their infinite wisdom, they said, no, it is 50%. We're going to charge you 50% because there's no reasonable grounds for the tax position taken. Now, my logic tells me, if the tax court actually agreed with you, with the taxpayer, that it should go through multiple layers, and they even had a tax opinion supporting that fact, then surely you had reasonable grounds for the tax position taken. Why did SARS take it on appeal? I would have just assumed that they could say, okay, let's abandon it if the tax court, and I actually think that the rules should be changed. I think it said, if a court find that there is technical grounds for the position, then SARS should abandon their understatement penalties. But their attitude on understatement penalties, because it's so big, because it's 25%, 50%, they just try their luck on 25%, 50%. It's become an income stream for SARS, and they start relying on the income stream to such an extent that they start budgeting for it. It should not be a budgeted income stream. It should be something that comes just extra, because it's there to penalize the taxpayer for bad behavior. Here, the taxpayer was in the bona fide belief that the same principles as 25B should apply to capital gains as well. So, unfortunately, the court found that that on a technical grounds, it was not there. So, but SARS imposed an understatement penalty of 1.5 million rand, which is 50% of that. There is no reasonable grounds for tax position taken. And what's also happening is that the Thistle Trust had obtained a legal opinion, which another entity in that group, the Zenprop group, has sought. So, but now, if you read this in paragraph 29, however, during the argument before us, counsel for SARS conceded correctly that the understatement by the Thistle Trust was a bona fide and inadvertent error, as had believed that Section 25B was applicable to its case. SARS conceded it. So I don't understand why we're in court at all. If SARS concedes that it's a bona fide inadvertent error in court, they say, yes, we know it's a bona fide inadvertent error. They did this. Why? So they said, though the Thistle Trust erred, it did so in good faith and acted unintentionally. In the circumstances, it was conceded that SARS was not entitled to levy the understatement penalty. So what's the lesson that we should learn out of this? It is, so as we are preparing tax returns, as we are doing our day-to-day tasks, the importance of tax compliance is so important. It's not just filling in a form and hope the SARS doesn't investigate you. With the demise of the IT14 SDs, almost everyone is getting requests for informations. So you've got to have your ducks in a row before you press that submit button. The days of doing a tax return for 2,000, 3,000, 4,000, 5,000 rand is long gone. You have to do proper work. And it's not about, because if you do 2,000, 3,000, 4,000 rand worth of work charge 2,000, 3,000, 4,000 rand for a tax return, then you can only do so little work. And then you're exposed. As a taxpayer, you're exposed. You've got to say, listen, I want to do proper work. I want to go through a sequence of events. And the sequence of events is a step-by-step approach. First step is you understand the industry where the client operates. So you anticipate any tax consequences. So in this case, you said there's multiple trusts. The industry that's the way it happens. So you've got certain specific rules. Before February, you've got to vest the income. You've got to vest the income. If there's an uncertain tax position, because this thing has been going on for 4, 5, 6 years, where there's uncertainty about the vesting of capital gains right through it, then you get a proper senior counsel opinion. If it is so that you can say, okay, I've got to make sure that I protect my position. So in this case, the Thistle Trust actually protected them, and they didn't even have to prove it, because SARS have to prove that it was not a bona fide inadvertent error. And that is an important aspect. So here the Thistle Trust said, but we truly believe this. And the tax court agreed with us, and we had an opinion. SARS, where do you come from that this is not a bona fide inadvertent error? So this is a very interesting case for this. So what I did is I read the Guide to Understatement Penalties. And SARS has got a whole paragraph dedicated to what is a bona fide inadvertent error. And they carry on about what a bona fide inadvertent error, and they try to make it overcomplicated. In my mind, they overcomplicate it. They go into the detail and say, what is a bona fide inadvertent error? And they effectively conclude that a bona fide inadvertent error is only something where you make a transposition error, or a schedule was wrong, or anything like that. They said you can't really make a bona fide inadvertent error if you take a tax position, which is absolute nonsense, because a bona fide is the opposite of bona fide inadvertent error, is that it's a mala fide on purpose error. Okay, SARS looks at it much more narrow. They say, okay, bona fide, it's got to be both. It's got to be bona fide and inadvertent error. So even if you're bona fide, you can be totally bona fide in your, you won't have any mala fide intent. The inadvertent cannot be avoided. It cannot be avoided. It says you could have avoided it by taking the right tax position, which is absolute nonsense, because it is something where you can take a tax position, and that you do it in carefully, and even the tax court agrees with you. And then if there is an error at the end of the day, that's life, because you get up to a Supreme Court of Appeal, 5 judges, 3 for you, 2 against you, or 3 against you, 2 for you. At the end of the day, it is just opinions. And as we know, there are many appeal court cases that are actually incorrect. So this is something about protecting yourself from that. All right. So in the SARS guide, they talk about such an error is differentiated from others that result in a statement by the term inadvertent. So they're saying, even if you're bona fide, it must be inadvertent. In other words, the understatement must result from an unintentional default, an accidental omission, an unplanned statement, an involuntary failure to pay the correct tax, and an unpremeditated impermissible avoidance arrangement. So now that's too narrow, I think. And the court here has also found that it is too narrow. So this is in a very important case if you want to argue bona fide inadvertent error. Okay. So as you can see here, I believe now SARS, after these court cases, they've got to go and reword this guide, because they're saying from the foregoing, it seems likely that the only errors that may fall under bona fide inadvertent errors are typographical mistakes. What nonsense is that? So only properly involuntary ones. Okay. But what they're also saying, this does not mean that the lack of reasonable care will be excused. And they're making the example there that a capturing error occurs because the clerk wants to go and play golf. Again, nonsense. It doesn't happen like that. So it's not the clock that goes and plays golf. It's the owner that goes and plays golf. Anyway, so that is you can read through this. We will obviously distribute these slides afterwards. So please take some time, read through it. But whenever you are responding to a request for information, SARS has got a very nasty habit. They send a request for information. And then the last sentence, they say, please tell us the reasons why we should not be imposing understatement penalties. Again, absolute nonsense. Because Section 1022 of the Tax Administration Act tells you that the onus to prove that the behaviors on which an understatement penalty is levied rests on SARS. It's not on you. So if you really feel a bit of aggressive about it, just as they ask that, you say, we don't need to answer this because it's on you, SARS, to prove, firstly, that the error is not bona fide inadvertent. And then once you say it's not bona fide inadvertent error, then it carries on. Now, this one is a very, very interesting case. Lance Dixon Construction CC and the Commissioner for Inland Revenue. It's an interesting case because for me, it's a bit of a cacophony of errors that the taxpayer actually made. And then they got a bit of an out of the jail card because SARS didn't take the right procedure. So you must always remember that a court case is very narrow. It deals with the situation in front of it. It doesn't deal with ancillary issues. The court cannot take the position of SARS. Once you've gone through the process, you submit a return. SARS reviews the return. SARS sends a letter of audit findings, says, we disagree with that. You respond to that letter of audit findings. SARS have got to then say, I'm reassessing you, and this is exactly the reasons why I'm assessing you. Exactly. We disagree with this, and therefore I'm assessing you for this. Once they've assessed you, then you go through objection process and everything. Only after even the ADR does it get to a tax court. And then from the tax court, it goes to high court. From the high court, it goes to appeal court. Sometimes it goes directly from the tax court to the appeal court. But it's very narrow, very, very narrow. In this case, it's a very narrow case. So don't read into it wider. But it's got a sting in the tail, and it's got some lessons that we've got to learn out of it. So what happened in this one? A cacophony of errors. So what happened is this Lance Dixon company had a related party. Now, I don't know how they're related, but the related party is Qualimar Construction CC. So it seems that it was, because it's a CC, so you've got to have it owned by individuals, natural persons. So it may have been just a developing company. So the company that owned the land sold the land to Kwamali Construction for 25.2 million rand, which was 72 individual AFs at 350,000 rand per AF. Now, in the agreement, and this is the first error that was happened, the agreement of sale provided that CGT on the entire transaction would be paid by the taxpayer on an ad hoc basis, as and when each individual AF was so on-sold by KMC and the relevant amount had been received by the taxpayer. Now, firstly, you can't override the law by a contract. So yes, the contract can state what your intention of that is, but you've got to have a tax opinion supporting your position. Now, any person that's got tax 101 will know that the time of disposal for capital gains tax purposes is the date on which you sign the agreement, or if there's a suspensive condition agreement, it's a date the suspensive condition is met. So if you sign an unconditional agreement that says, I'm selling this to you, and the proceeds is 25.2 million rand, but then the payment is just delayed up to future events, the time of disposal has happened, and everybody knows it. That's the one debate. So you go in on the time of disposal debate, and undoubtedly, if you've done tax, you know, yes, that's it. So this position has got no support in it. But there's an extra end. You've got the time of disposal, and then you've got the definition of proceeds. The definition of proceeds is you only include in proceeds amounts that is unconditionally accrued to you. So what often happens in these things is you're saying, I'm selling the land, okay, but the proceeds will only accrue to me as and when you sell the property, which means that there's a time of disposal on day one and you peg the value. And if capital gains tax were to increase on 80% inclusion rate to 100% inclusion rate, there's still the 80% inclusion rate. But you only include the proceeds as and when it unconditionally accrued to you. I've not seen this debate anywhere in this court case. So this is quite interesting. I think they have not properly analyzed the contract, because I think what they try to do is to do it in that manner. So let's see how the cacophony of errors then happened. SARS challenged it, and what happened, and I'll get to that one first, they did probably an IT14SD. Because they said they picked it up because they saw, hang on, there's output VAT on 25.2 million rand, but you have not disclosed this proceeds in your income tax. It's a reconciling item in the IT14SD. So they asked why. They said, no, we've done this. Now look at the answer that the taxpayers' auditors have given you. We're not in agreement with the decision made by SARS and also obtained a legal opinion in this matter. Okay, good for you. According to paragraph 39A of the 8th schedule to the Income Tax Act, this capital gain should have been ring-fenced and the loss carried over to the subsequent tax year. The reason for this is that none of the 72 AFRIN that were transferred to Kwale was sold. Paragraph 6 of the deeds also clearly state that all conditions for the transfer must be met before the capital gains can be realized. How can you have the paragraph 6 governing whether or not capital gains? It is the law. There's no reference to the 8th schedule. As these AFRIN were not sold, this is not the case, and the capital gain has to be ring-fenced until the AFRIN are disposed of. There's no technical argument. So what is the first lesson that you learn here? Don't be blasé when responding to requests for information. So often you get your auditors, you get your advisors to do your tax compliance. Then you get a query and you just want to get it off. So you don't put proper effort and you think again, okay, this is this routine. Let me, and it's such a grudge purchase because now SARS have asked a question and you don't want, you said, but you've got to have it right. So you just have to have the answer right. So what auditors often do, they don't even send it to the tax department. They just try to answer it quickly and you don't fight it at that point. My philosophy is we are not tax litigators. Creston is not tax litigators. Our job is to make sure that you don't get to court. So if this thing came to this point, I would have answered it and say, guys, yes, there has been a time of disposal, but this is the definition of proceeds. Proceeds clearly state that there's only needs to be included in proceeds if there's unconditional. There's a conditionality to this inclusion. The conditionality is that KMC will have to on-sell it. That's a conditionality. I don't see this being argued. Now remember, this now gets to the Supreme Court. And so they took it to the tax court and they said there's been some debate in the tax court, and I didn't see the tax court case, and they were debating whether or not there was an understatement, but then they conceded. So they conceded because probably they didn't put the effort in writing the agreement properly so that the conditionality of that is there. But I don't know. But yeah, remember now it gets to the high court, and this is a high court case. And the high court says, well, I'm not considering whether or not there's understatement. They've already conceded that there's understatement. Okay. Now this is the important bit, paragraph 13. This just summarizes the process what SARS must do. So please, whenever you are responding to a SARS understatement penalty, or you do an objection on SARS understatement penalty, this is the bit that must be always quoted to say the Lance Dixon Construction CC case dictates that the following process must be followed by SARS. Okay, it says here, it follows that in circumstances when alleged understatement of taxes occurred, a three-phase process is contemplated by a legislator. It summarizes beautifully. Okay, firstly, SARS must consider whether the understatement constitutes an understatement as defined in Section 221 of the Tax Administration Act. The first one is, if you're disputing whether or not you've made an error, you firstly say, you cannot impose understatement penalty because there's no understatement. We've done the taxes right. There's no understatement. We are not conceding on the understatement side. Okay. So if it does, now there is understatement. So yeah, they've conceded. No, sorry, we made a 25.2 million rand error. Then it says, if it does, SARS, not the taxpayer, SARS, must then consider whether understatement results from a bona fide inadvertent error. If such an error is established, that is the end of the inquiry, and no understatement penalty may be levied. Finish. So first step is the understatement. Second step was the bona fide inadvertent error. Now, this case doesn't deal with bona fide inadvertent error because the taxpayer didn't raise it. The taxpayer didn't say, well, it was a bona fide inadvertent error. My logic told me I need only pay the capital gains tax as I get the cash. I thought, the proceeds is conditionality. It should only be included. They didn't raise it. So if you don't raise it, you can't use it. Okay. However, where there is no such error, so that it is not a bona fide inadvertent error. So now it's such powerful words. Is it a bona fide inadvertent error? And then it says, no. Okay, now in this case, they didn't even debate it. So the High Court didn't debate bona fide inadvertent error. So say, however, there's no such error. SARS, not the taxpayer, is then required to identify the appropriate behavioral category under which the taxpayer's conduct allegedly results in terms of the table set up in the section. Only then do you get to the table. So the SARS guide is incorrect because they say you've got to read the bona fide inadvertent error in the context of the table, which is nonsense. The table, according to this High Court case, is not relevant if there is a bona fide inadvertent error. So can you see that if SARS issues a publication, it's not law. It's not law. That's just their interpretation of the law. We and SARS have got exactly the same objectives. SARS' objective is to apply the law that has been implemented by Parliament. SARS cannot make law. Our objective is to apply the law as enacted by the Parliament. That's it. So, but we look at it from different views, and often now SARS sees their role to be debt collectors, which is unfortunate. They are tax administrators. They must administer the law according to the impartially, and they must read it and then say they shouldn't interpret it to the best benefit of government, which is nonsense. They should interpret it in accordance with the way the law reads. It's the same way as a traffic officer, a police officer. If they stop you in a traffic stop, the law says your alcohol level may not be more than that. That's the law. They can't interpret it and say, well, okay, this guy is, looking as if he's still okay, so he can go. The other guy looks as if he's no. That's the law. They should apply the law as it stands. SARS is exactly the same. All right, and the law says you consider bona fide inadvertent error in its own. If there is a bona fide inadvertent error, that's the end of the debate. You don't even go to the table. Okay, SARS got a different view. All right. So what SARS did, and I think SARS felt sorry for the taxpayer because they looked at it, and I think in the back of their minds they were looking at it and they thought they've got some arbitration there. And so the behavior on 25% is reasonable care not taking when you prepare a return. Now that's a different debate. If you're absolutely blasé about your ITR 14 responsibilities, you just fill in the return and off you go, and boom, off you go. You do the tax return and you just fill it in. So reasonable care is you've not done proper schedules, you've not applied your mind properly, you've not, if there's complex issues, you've not asked for advice, all those kind of things. What is a reasonable person? So what is a reasonable person's action that you can expect from somebody in your same position? Now, for somebody like me that's been doing for tax for 30 years, reasonable expectation when I look at something is different from reasonable expectation for somebody that knows nothing about tax. And so there are certain things that you'll expect differently, but you do expect a company that's got some resources to actually get specialist advice when they're doing a tax return on their extraordinary. That's what you'll expect a reasonable person will do. If you've got a transaction, a 25 million rand transaction, you would expect a reasonable person to say, listen, maybe I should get some, but that is, but when you look at the tax return preparation process, you look at it in totality. If there's a tax pack, if there's a process, if there's a review function, then you say, but I've taken reasonable care in preparing my return. So you can't impose it. The fact that I make a mistake doesn't mean I've not taken reasonable care. Okay. So, and this is quite important. In formulating their pleadings, the parties are bound by the factual and legal basis upon which the disputed assessment was initially made and challenged. A change of track requires a revised assessment. This is where the process went wrong. Okay, so SARS said reasonable care not taken when preparing the return. Now, what does these rules say? So I'm going to deal with the rules later. These are these new rules, okay? So it says here, as you are doing a Rule 31, so before you go into court, so you've now gone through objection, gone through ADR, and now you want to go to court. So in that court, the taxpayer makes a submission, a statement of grounds of assessment, and opposing appeal. So SARS makes a statement in Rule 31. That's Rule 31. Now, in Rule 31, they're saying SARS may include a statement of new ground of assessment or basis for the partial allowance or disallowance of the objection, unless, so this is what they can't do, it constitutes a novation of the whole or the factual or legal basis of the dispute assessment, or which requires a new assessment. So SARS, there's a degree to which they can bring in new grounds of assessment. If the degree of it is a revision of the factual or legal basis of the dispute assessment. Now, in this case, they have an assessment. They said the factual basis, you've not taken reasonable care. They can't change at this point the factual basis to there's no reasonable grounds for tax position taken. It's totally new. It's a whole of the factual basis on which you send it. So when you get to Rule 31, it's too late. You have to stick to your guns. So SARS had no doubt they had to stick to their guns. Okay. So Rule 34 says then the issues in an appeal to the tax court will be those contained in the statement of the grounds of assessment and opposing the appeal, read with the statement of grounds of appeal. Okay. So the tax court, the issues in appeal to the tax court is limited to those things. The tax court can't go and rule on auxiliary things. If it's not in front of them, they don't rule. So you've got to be careful when you look at tax cases. So often people will say, oh, there's been this case that you can't do catch-up claims in 11E. It's nonsense, because that case dealt with understatement penalties. It didn't deal with the catch-up claims in 11E. So you can't do that. Okay. So what SARS doing, they said this is 25%. Now, here it is, reasonable care requires the taxpayer to take the same care in fulfilling his tax obligations that could be expected of a reasonable ordinary person in the same position. That's reasonable care. Okay. Now, the taxpayer said, interestingly enough, so the taxpayer said, hang on, I took reasonable care when I prepared my return. Look, there's a tax back, there's everything there. If there is a mistake, it didn't come out of the process of tax return preparation. It didn't come out of the tax return preparation process, which is a process. It came out because I took a tax position. My tax position was I've only got to pay the capital gains tax as it arises. That had nothing to do. Once I've taken a tax position, then this was just a consequence of that. Okay. So the taxpayer said, SARS, yes, I'm conceding, probably incorrectly so. There was no it was not a bona fide inadvertent error. I'm conceding that there was no reasonable grounds for the tax position taken. Okay. But now SARS was in a corner. So now this is something which is often underestimated, is when you get to court, it's a human thing. There are people with emotions and everything in at both sides that are relevant on this. So when the SARS official who did the assessment was under cross-examination, rigorous cross-examination, what happened? When pressed under cross-examination by Dr. Marie, the witness is now the SARS witness, fell about, but eventually accepted that she had chosen the wrong behavioral category in assessing the understatement penalty. She vacillated between contending that the behavior of the taxpayer was unreasonable in failing to include the CGT figure in the 2017 tax return to unreasonable in relation to the basis for the tax position it claimed to have taken. Eventually, Ms. Muratori conceded that SARS had erred. Look at this. Eventually, Mrs. Muratori conceded that SARS had erred in imposing a 25% penalty on the basis of item 3, or item 2. It had relied on and accepted that the position contended for the taxpayer was viable, eventually stating rather opportunistically saying, okay, looking at the facts, I must say that SARS lost the opportunity using 50%. You're in court. This was in tax court. Obviously, now the High Court looks at what's happened in the tax court. And they said, in the tax court, you, Mrs. Maratori, you said, okay, looking at the fact, I made an error. I should have charged 50%. And then they say the witness then rather brazenly. Now, does that not explain so often our relationship with SARS? The witness rather brazenly, beautiful explanation, went on to suggest to counsel for the taxpayer that his client should be happy with a lesser penalty because its conduct has been unreasonable either way, as if SARS has got a choice in the matter. The evidence clearly demonstrates that the witness manifestly did not understand the difference between the behavioral categories in items 2 and 3. Again, beautifully, SARS doesn't understand their own law. They've got a law, they go to court on the way that they've implemented the law, and they say the person who's got to implement the law manifestly did not understand the difference between the behavior categorized in items 2 and 3. And I wish SARS would just give their people some training in this. In light of the damaging concession made by SARS, only witness the taxpayer astutely. So the taxpayer fortunately had a good counsel, closed his case without calling any witnesses. And I said, well, SARS, you've now dug your own hole here. Good luck for that one. So what happened in the tax court? So the tax court then, funnily enough, this is amazing because the tax court should then have just said, well, you chose the wrong thing. The tax court then actually said, but you've imposed 25%, you should have imposed 50%. So we can't change it. So we're just going to uphold the 25%. And that, then the High Court said that is nonsense. They said, you can actually increase it, but only if SARS went through the rigmarole. If SARS issued, they are bound by this Rule 31. And remember, I said that you can't change your tact midway. So SARS lost the opportunity to increase it to 50%. So the tax court can say, well, alternatively, you've now revised the tact, but you've got to issue a new assessment. They never issued a new assessment. So what the court then found is that, sorry, SARS, you've lost your bite at the cherry. The law says, the law quite categorically says that if you look at the understatement penalty table, you have to choose the largest one. You don't have a choice. You can't say, well, I know it's 50%, but let's go for 25%. They can't do that because that you can't do. You can do it in the ADR. In the ADR, you can actually settle. You can go with SARS and they assess you for 50%. Then you can go in the ADR because the ADR is almost a legislative making process where you and SARS actually agree by law, by contract, that you can change the law. They can say, okay, yeah, let's just settle. But it's then out of the settlement process that you do that. Okay. So, and then it says it follows that the tax court was wrong in confirming the understatement penalty of 25%. All right. So here, it's very importantly, it follows that, for example, SARS finds that there has been an understatement-based penalty on the taxpayer failure to take reasonable care in completing the return. It must impose 25%. It does not have the discretion to lower the percentage. It's in law. All right. So the High Court then upheld the objection. But it's interesting now, you've got to look at what's the consequences of this. What does this now mean for us? Firstly, SARS is going to be much more careful. In the olden days where when you receive now assessment, they looked at it, they're now going to go through that process as well. We're not the only people that's now going to go through the process. SARS takes care of these things. So SARS is going to go through it. They're going to say, okay, guys, let's have this process ready. First, bona fide inadvertent error. Let's consider it. Let's apply it. Then I'm going to say, here's the penalty table. And no matter how I feel about you, poor taxpayer, I've got to go for the highest one. If it's 75%, it's 100%, it's 150%. If it's 50%, I've got to go for the highest one. Then I've got to substantiate it. Because the moment that I go for 25%, I should have gone for 50%, I'm going to lose the whole thing. Okay. So this is a bit of a sting in the tail. This is a win for this particular taxpayer. But for the industry, we now can expect a lot more understatement penalties being charged at a higher level. Because I've often looked at it. And then people said to me, you know, what's the percentage charge going to charge me? It should just be 10% because it's more than $1 million. I said, no, they've got to go take the highest one. Yeah, you've taken a position. There's no reasonable grounds for the tax position taken. It's 50. And that's what and SARS doesn't have a choice. It's not, they can choose any of between 10. And there's a reason for that. because the law has changed so much to take away the discretion of SARS to make serious differences, because the moment that you give SARS discretion, then you have got favoritism. Then the one taxpayer gets away with 25%, the other one has got to pay 50% just because they've got favoritism. All right, but let's look at where this went wrong, because they actually picked this up. In paragraph 104, it says, in the VAT 201 for the 10-2016 VAT period, the taxpayer also declared standard rated supplies of 25 million, thereby acknowledging the process of 25.2 million rand VAT from the sale of that ash. Okay. So they included this in the VAT return, but they've not received the money. Now, was that right? So here's an extract from the VAT Guide 409, which deals with fixed property and construction. It talks here about the time of supply, paragraph 4.3. So remember, the general time of supply is the earliest when you receive any consideration, when you issue an invoice. Not a tax invoice, an invoice. An invoice is any document indicating obligation to make payment. That can even be a contract. So they're saying here, the general rule for time of supply is the invoice being issued or the payment of consideration being made. However, the supply fixed property has a special time of supply rule, which is the earlier of the date of registration of transfer of the property in the deeds registry, or the date on which any payment in respect of consideration for the supply is made. So when you sell fixed property, just as much as the 8th schedule of the Income Tax Act has got special time of disposal rules, for that purpose, is special time of disposal rules. So if the moment that's in the deeds registry, assume there's no payment yet. When the moment's in deeds registry, that's a time of disposal. The relevance of that is it fixed the tax rate. So when the tax rate increased from 14% to 15% in April 2018, if the registration happened in February 2018, the rate is fixed at 14%. Right. Now, then it goes on. Notwithstanding the special time supply rule, the supplier of the fixed property will only be required to account for output tax on the supply in the tax period in which payment is received. What? So these guys, they had a 25.2 million rand, they charged VAT on it, they paid the VAT on it. But the other company in the KMC, they obviously claimed the input VAT. But they didn't even read the CGT, the VAT one. So this means that even though the VAT liability is pegged at 25.2 million rand times 15 of 115, meaning 3.2 odd million rand, the VAT is only declared in the VAT 201 as and when payment is received. So, and this is often a problem within group companies, but it's a problem always. So when you sell fixed property, you've got to keep track now. So it's registered in Deeds Office in March 2018. If you receive the cash over the next 3, 4, 5, 6, 7 years, as and when, now that loan attracts interest, obviously there's no interest, there's no VAT on the interest, but as the capital amount gets paid, you've got to pay output tax and the other guy can claim input tax. That's the rule. So the originating cause for this whole dispute came about because they didn't get the VAT right. So what are the rules for me? It's amazing for me. I'm still dumbfounded how taxpayers can do this, because this company has done a massive transaction, 25.2 million rand transaction. They didn't think about, in my mind, getting proper tax advice. Proper tax advice would have said to them, hang on, it's a no-brainer. There is special rules on fixed property. Look at it. It's just there. You just go, it's SARS, tell the VAT 109. Go look at it. It tells you that you only need to pay the VAT as and when you receive the cash. It's there. It's there. What did they do? Pay output tax and input tax. They didn't get any advice. So that is where it started. Then they just put in the contract, oh, this is how we're going to pay the capital gains. How can you do something in a contract that way? Then when the query came in, they just said to the auditors, just quickly answer this thing, answered it like, oh, okay. They didn't go into the technicalities of it and get proper tax advice. And then they ended up having a costly dispute about this whole thing. They got out of jail on a technicality, on the understatement penalty, but they still had to pay the capital gains tax. They could have avoided the whole cacophony of problems by just getting the tax advice. And this is what I'm saying. We aim for tax certainty. You have to increase your budget for tax advisory services and tax compliance services. And it's got to be linked in. Don't say, well, I've got a tax advisor and I've got a person preparing my return. The person's preparing your returns got to take due care. They've got to know the law properly, because as you do a tax return, you're actually taking tax position where if you ask somebody to do a tax opinion for you, you go to senior counsel, or you go to wherever, and you say, give me an opinion on that thing. Often they don't even think about the VAT consequence of that. What you need to do is to get yourself a tax advisor that's got that wide spread of knowledge that can unpack the events and say, okay, here's the event. Firstly, what do we do for accounting purposes? Secondly, what do you do for VAT purposes? Thirdly, how do we disclose all of this as we get exemption for my transfer duty? Thirdly, what is the capital gains tax consequences of this? Is there any recoupments, income tax consequences? How do I disclose an ETF? You get the whole package. This could all have been avoided so easily. All right, some lessons learned. Now, here's an interesting one. The Commissioner for Inland Revenue and Coronation Investment Management Pty Limited. Okay, so Coronation is obviously a massive company. It's one of the most successful companies in South Africa. And believe you me, one of my ex-partners, Gavin Tipper, is the CEO of the group. Extremely competent people at Coronation. They know their affairs. They do things on a right way. So they don't make calls without actually getting proper tax advice. And they've got more than enough money to make proper tax advice. So, and here's a highly technical matter that went. Coronation Investment Management had a company in Ireland, and the company in Ireland, let's call it, did stuff. Okay, so they did investment management and services and everything. Coronation got a tax opinion as to whether or not the company in Ireland should be imputed in terms of Section 9D of the Income Tax Act. That opinion was, no, you don't have to impute it in terms of Section 9D. So this matter progressed through the courts, and the Supreme Court of Appeal, I'm not going to go into the technicalities of Section 9D, and remember, any 9D, they wanted to rely on the foreign business establishment exemption, and that is very case specific. So this is generally a question of fact and not a question of law. So and often a question of degree, because you do have management on the ground, you do have people on the ground, but then you say, is this proper? Does it fall within those foreign business establishment? And the Supreme Court of Appeal found on the question of degree that it should have been imputed. So they lost the case. Now, the other thing is the taxpayers are losing 80–90% of the cases that goes to the appeal court. So unfortunately for Coronation, they lost it. Court found you've got to impute it. Okay. But then it went, and the SARS said, we're going to charge you a 10% understatement penalty for a substantial understatement. So it falls within that rule. Now, as you know, if you have a Section 223 opinion, so Section 223 opinion says it must be issued by an independent registered tax practitioner that concludes on a certain basis in the opinion that if in that person's opinion, if this matter were to proceed to a court of law, it is in his opinion more likely than not that the court of law will agree with him. So the level of certainty is more likely than not. 51% is fine, okay? But it's based on what's in front of you. Will a court of law find as you have concluded here? Okay. You can't make assumptions or anything. So I'm not going to go into that, but Coronation said, we've got an opinion. We've got an opinion from one of the leading people in one of the leading tax practitioners in the country, and they've concluded we don't have to impute. Okay. Now, the substantial understatement, apologies, I said 5%, it is R1 million or 10% of the tax that would otherwise have been paid. So it falls outside that range. So what SARS then does, SARS says, okay, show me your opinion. And Coronation said, no, we're not going to show you. It's privileged. We're not going to show you the opinion. And then SARS said, SARS relies on this non-disclosure to draw a negative inference that the tax opinion did not support Simsa's claim for the FBE exemption, and that a deliberate and conscious decision was taken to exclude the net income of CGFM. It is contended that this was not an inadvertent error. So this is an important one, because the other day I was asked to do a Section 223 opinion, and the client asked me, now, who's the audience of this? Should we prepare that so that SARS is the audience of this? Now, I've always taken the view, because Not all clients have got the financial resources that a coronation can have. Not all clients are willing to throw money. And if you're going to take things to the appeal court, it's easy peasy, 1.5, 2 million rand it's going to cost you. So not everybody has got 1.5 million rand to fight the matter to the appeal court. So our job is to make sure that we don't get to the appeal court. Anyway, so when I prepare a Section 223 opinion, I do it in such a manner that it can be disclosed to SARS. I make sure that it is very specific to the topic. So, for example, if it is a question on is Section 11A applicable or not, one topic, I do an opinion. If so, over what period should 23H be applicable, I'll do that as a separate topic. If SARS then queries the 11A deductibility, I've got an opinion. If SARS query the period over which a 23H was spread, I've got an opinion. The one is not related to the other. If it is so integrally, then I'll combine it. But for example, if I were to do an opinion on FBA exemption, I will limit it to FBA exemption. If, for example, I've got concerns about whether or not that Irish company is effectively managed from South Africa, I'll do that in a separate document. I won't put it in the same document. I won't say, in my opinion, it should not be imputed, but I'm actually of the view that it's been effectively managed in South Africa and it should be registered in South Africa as a tax register. Because then SARS, you've done my homework for me. So remember, SARS challenges something very specific. Anyway, that's always my opinion, but I agree that you don't have any obligation to give it to SARS. I like to do it in such a manner because the opinion I do exactly the same way as I would have done an objection. Very specific, anticipating SARS tack of attack and avenue of attack, and then I'll deal with that. And if SARS wants it, there it is. Very specific. I avoid anything negative that is not related to the matter. If there's anything auxiliary, yes, I believe there's no reason to impute in terms of Section 9D. But if I say, but I've got concerns about effective management, SARS has not raised effective management, I don't have to give it to them. Okay, so they've got to take it on that manner. So, but in this case, what the court found was that there was SARS cannot, the fact that this court has now found that this course is not open to it, does not in any manner reflect on the bona fides of SIMSA more than it reflects on the bona fides of any losing part in litigation. Insofar as the tax opinion is concerned, it was not incumbent on SIMSA to disclose the tax opinion that it had obtained any more than it would to any other party which litigates on the basis of a procured legal opinion. So you don't have to disclose your Section 223. My advice is still the best strategy with SARS is not to go to dispute resolution, not to go to objection, not to go to appeal, not to go to court, because you can't be so litigious, because at the end of the day, for some reason or other, the high courts and especially the appeal court is just finding for SARS 80% of the cases. So, and it's very, very costly. And SARS takes the money from you. You're fighting to get a suspension of payment. So I prepare things in order to blow SARS away. When an inspector comes and they ask a question and they say, please tell me what your view is on the FBA exemption, I blow them away there and they go away. I don't say to them, yes, you've got an opinion, but I'm not going to share the opinion. Go and do your own homework, and then you've just got them aggressive. Human element. People are human. SARS is human. We are human. But it is interesting here. This is by law to speculate that a tax opinion must have gone against SIMSA merely because it was not produced as SARS is simply speculative. It is not sufficient to attribute mala fides on the behalf of SIMSA. Okay. So very interesting one, but let's do it on that basis. All right. The last case I quickly want to deal with, and I know we're going to run about 15 minutes over time. If you need to go, please do so. You'll still get your certificate. But let's just deal with this one, because I've briefly alluded to this case, because what happened in this case was that it deals with understatement penalties. What the taxpayer had, they reviewed their tax asset register, and they were in an assessed loss position of about 20 million rand. So that assessed loss of 20 million rand, they looked at the tax asset register and they said, oh, frack, we have underclaimed wear and tear. So what we'll do is we'll do a catch-up claim for wear and tear. And they looked at the whole thing. Now, the way that they'll do the catch-up claim is, let's assume there was an asset that you could write off in terms of interpretation note 47 over 5 years. You've written it off over 10 years. Now you're at the end of year 3. So you'd have claimed 10, 10, 10. You've claimed 30%. You could have claimed at the end of year 3, you could have claimed 20, 20, 20. You could have claimed 60%. So what they did is they did a catch-up claim of the 30% unclaimed. So effectively, you would have claimed 10, 10, 40. Okay. And that extra 30, so it's a catch-up claim. And then in year 4 and 5, they'll claim 20 and 20. All right. So SARS looked at that catch-up claim, said, no, you can't claim the catch-up claim. And what they did is then they said, okay, that catch-up claim increased the assessed loss from 20 million rand to 37 million rand. The taxpayer conceded. First mistake. They should never have conceded. Anyway, they conceded. So that was the first step. Is the understatement? The taxpayer didn't even fight that. Then SARS said, okay, but it's 17 million rand understatement penalty. The 17 million rand multiplied by 28%, multiply by 50% understatement penalty gives you 2.5 million rand. They charged him 2.5 million rand understatement penalty. Massive. Okay, just for something like this. So the taxpayer then said, oh, that doesn't seem fair. This doesn't seem fair. Let's object against it. And they objected on the grounds that there was no prejudice to SARS, because bit of a potato, whether you have got 37 million rand assessed loss carried forward, or you've got 20 million rand assessed loss carried forward, and unclaimed 11E of 17 million rand claimed forward, you're in the same position. It became a claim in the future, whether it's as a future 11E claim, or whether it's not as if you're going to lose it 17 million rand, you'll claim it. And the court, and this is remember, this is just a tax court. This is not a high court. It's not an appeal court. And the court then supported the contention of SARS that there was a prejudice. Okay. 2.5 million rand. And that's absolutely ridiculous, because the penalty must fit the crime. And when you look at it objectively, how can this fit the crime? Because firstly, I would have looked at it and said, but hang on, you should not have conceded on the 17 million rand, because interpretation note 47 doesn't say you claim 10%, you claim 20%. It says you claim it over the estimated useful life of 5 years. Now, if I claim 10, 10, 30, oh, sorry, 40, if I claim 10, 10, 40, instead of 20, 20, 20, how could there be a prejudice to SARS? I'm still complying with interpretation note 47. I'm still claiming it over 5 years. I'm not claiming it over a shorter period than 5 years. I'm claiming it 10, 10, 40. So, and the fact that I'm claiming lesser at the beginning years and more at the latter years means that there's no prejudice. They didn't raise this, amazingly so. And sometimes I think it's because lawyers, you're kind of like, we as accountants, we work up to a point and then we abdicate it to the lawyers, and the lawyers don't understand accounting. So they could not work on that basis. So it is quite interesting that they didn't focus on that. So they should never have conceded in the understatement penalty happening in the first instance. All right. So that there's a lesson to learn out of this. Your strategy when you're working on a dispute should be properly considered. Don't settle too early. Don't acknowledge guilt too early. Don't do that at all. So I think they should never have lost this case. And there was, again, a cacophony of errors. The moment that they took the position in order to go on to the next step, the moment that they took the position and said, we're going to claim 17 million rand, they should have got an opinion from a tax practitioner that would have said, but hang on, we believe that you're entitled to the catch-up claim because the interpretation note says you can claim it over 5 years. Now that you claim 10, 10, 40 doesn't mean that you're outside the interpretation note. You're actually doing in a manner which is to the benefit of SARS, that you claim less in the beginning years, more at the end years, but still you're complying with interpretation note 47. It would have ended up totally different. All right. So that is the lesson under that one. Let's just go. Yeah, so I've elaborated a bit on what the law says, so you can look at that. All right. So in the last, we're now at 9 o'clock, and I'm going to take the last 15 minutes just to quickly take us through the new rules. So as you can see, this is hot off the press. On 10 March 2023, there was new rules that was promulgated. Please go and take it and take the effort to read through it, especially the bits dealing with requests for reasons, the objection side, and just to get yourself an understanding. So the most important things that you've got to look at is in these rules, a day is defined. A day is defined, which is a business day as defined in Section 1 of the Act. So business day means a day which is not a Saturday, Sunday, or public holiday. And for purpose of determining the days or a period allowed for complying with the provisions of Chapter 9, excludes the days between 16 December of each year and 15 January of the following year, both days inclusive. So, but be careful. So often when SARS is in a request for information, they say to you, you've got 21 days to respond. That is normal calendar days, okay? When you're in this dispute reasons, when you get to requests for reasons, the moment that it's a revised assessment, that's when these rules kick in. And that is when you can say, when they say day, it means business day, right? So the definition of a day, and it's unfortunate that they've used in the rule the term day when they should have used business days. SARS, in their correspondence to you, often just use the word days. They should also be using the words business days consistently, because there's a reason why business days there. They should say, give it to me consistently. They should, and I would have liked SARS in all instances to say, please respond to this in 21 business days. Then it's within this framework. There's a reason why these days are excluded. There's a reason why 15 December to 15 January is excluded, because nobody is there. It doesn't help SARS, and I've often seen it, to send a request for information on the 14th of December, the day before they go and leave, and they say you've got 21 days to do it, and then by the 15th of January, you've got a revised assessment because you've not responded. What nonsense is that? That's not fair, I think. When you're in doubt, ask SARS, do you mean days or business days? Okay, but these termination of business days, so when you're dealing with the Act, if they don't say business days, it's not. If they ask a request for information, then it means days. A day is a day, not a business day. All right. But in these rules, a day is a business day. All right. So here's an important things in the reasons for assessment. So the process is, if SARS gives you an assessment, the process should be request for information. You give them information. They analyze the information. Okay. Then they've got an opportunity to say, okay, we're happy, or they've got an opportunity to then say, we escalate this to a proper audit. Once they escalate it to a proper audit, they've got to notify you that there's an audit ongoing and what the topic of the audit is. Then they ask you additional information under the audit, and you give them additional information. Then they've got to give you a letter of audit findings. In that letter of audit findings, they say, these are our findings. We believe we're going to make a revised assessment. You're going to make a revised assessment, and then they've got to give you a revised assessment. If they don't like they give you opportunity to respond to a letter of audit findings. Often what happens is you get a request for information, they look at it, boom, before you know it, there's a revised assessment on the table. Often, especially on VAT, that's what happened. They give you the standard one, and you give some tax invoices, and before you know it, there's a revised assessment. You don't know what invoices were reversed, and you've got a revised assessment. Then what you do is you send to them on e-filing, you say request for reasons, and it's notified. And the request for reasons is important because, as I said previously, if you object, your objection is limited to the situation in hand. You can't now raise other grounds of objection. If you don't know why they're assessing you can't give a proper objection. You don't know what to respond to. So they've got to give this to you. So you've still got within 30 days of the assessment. If they just assessed you and you don't know what the reason for the assessment is. Now remember, these are business days. So you can ask them, listen, give me reasons of assessment. Then SARS looks at it, okay? And then they've got 45 days to then respond to you, okay? So these days are all the same. Read through this. Then for you to object against the assessment, you have to then 80 days. Now, previously it was 30 days. So this is a long period. Remember, it's 80 business days. So once you've got the reasons for assessment, or you've got the actual assessment and you don't apply for reasons of assessment, then there's 80 days after that date that you can then do a proper objection. Now, I welcome that. Now, I think 30 days to 80 days, it's long. It's long because it gives you more than 3 months, actually. And in the meantime, they're asking you for your money. They're asking you for, you can ask for suspension of payment, but they're on your case because the collection guys are different from the assessing guys. But this is an important one. The 30 days time for you to object has now been extended to 80 days. All right. Now, if you want to extend, you've got to go and look at section 104.4 and 5 of the Tax Administration Act. Now, when it was 30 days, often what happens, SARS issue a revised assessment. Sometimes the public officer has changed. We've seen public officers emigrating. They resign, and now the emails goes to him. It doesn't. The revised assessment doesn't go in e-filing, or you don't pick up it on e-filing because you don't get any notification of it, or for some reason nobody checks it. Okay. So that the period in terms of section 104.4 and 5 of the Tax Administration Act, SARS can extend the period by 30 days, again, business days, if there are reasonable grounds. So reasonable grounds is the public officer resigned. Somebody was sick for a week or something. They missed it. Whatever reason is reasonable grounds. They can extend it for longer than that, but only if exceptional circumstances are present. Now, exceptional circumstances is death. Those riots that we had in July 2021. COVID was exceptional circumstances. There could be a reason why somebody was not there. An extended deathbed, extended sick bed. So that's exceptional. So generally, so you've got 80 days in which to lodge your objection. That can be extended by 30 days if there's reasonable grounds. It can be extended for up to 3 years if there's exceptional circumstances. Exceptional circumstances, not that you've appointed a tax compliance officer, somebody that manages your e-filing, and they fail to look at it. And because of this, hold the view that if you request somebody to manage your e-filing, it's not just, you've got to pay for that on a monthly basis because somebody's got to be paid to monitor it on a monthly basis. You can't not pay for it because it's an action that you want to be taken. So once you pay for it, you can demand for that service. Because one of the roles of the e-filing person holding the e-filing is to constantly monitor the e-filing to check, is there any documentation? Is there any responses? Is there anything in there? And you've got to have an e-filing manager for that. All right. So the objection against assessment, all of these things are unchanged, but please look at it because it sets here what you must do. Okay. A taxpayer lodges an objection to an assessment must complete the prescribed form in full. That is the NOO forms on e-filing. So you fill in the NOO form. And here is your formula. Set out the grounds of the objection in detail. So this is in detail. Specifying the part or specific amount of the disputed assessment objected to. So you've got to say, I'm objecting against the capital amount, objecting against the understatement penalty, I'm objecting against the interest, I'm objecting against the late payment interest. So that is all that you've got to do. And you've got to specify that specifically. Okay. You can't later, if you're in objection, you're not objecting against the interest, then you can't later raise it. Because if you don't object to interest, you're gone. So you've got to make sure that every single objection, people say, oh, just quickly do an objection. Then you only do it against a capital amount, but you've got to do a capital amount. You've got to do understatement penalty. You've got to do the late payment penalty. You've got to do an underestimation penalty. You've got to do the interest. All of them has got to be specified. And all of that is unchanged. All right. So again, a taxpayer receives a notice of invalidity of this. So sometimes you lodge your objection. SARS look at it, says invalid because you're beyond your 80 days, you're beyond your 30 days, you're beyond the period allowed for. Then you've got a time to resubmit. Or they say, listen, it is invalid because something is missing there. You've not filled in the form properly or anything. All right. SARS can then go back to you and say to you, listen, give me more information. Thank you. We've taken note of the objection. We didn't know these things. You have said that you've got a Section 223 opinion. Send us the Section 223 opinion, for example. And you can say, okay, I'm willing to give it to you. I'm not going to give it to you. All right. And then, again, those things, but here are rules. SARS must notify the taxpayer of the allowance or disallowance of the objection and basis thereof under Section 106(2) of the Act. Now, this is quite important. Please read through this. Within 60 days, again, 60 business days after delivery of the taxpayer's objection, or within 45 days if they've asked you for additional information. And then they can extend it for another 60 days, but I've got to notify you of this. We've got to start holding SARS to this. And too often, us as tax practitioners, we look at these things, and so we think we just go through the motions. We think we're going to go through the motions, and we're just going to ask to the technical side of it. But it becomes just as important for us to know the process that is relevant for this. Then, if the objection is denied, you can appeal to it. Now, importantly here is the time period is now 30 days again. If you've done your work properly under the objection phase, the appeal is, well, here's your objection. There it is. You can add grounds of objection, but it can't change your principle substantially. Okay, so that's why the objection is very important. But you can't now bring something totally outside there and say I'm appealing on this grounds. And that's why the process of doing an objection is critically important. Now, if you take that Lance Dixon case, it was so poorly worded, that response to the request for information. It's shocking. It's absolutely shocking. It should be properly worded in a tax language done by somebody that understands tax laws. Everything else have remained unchanged. So it says you can alter the grounds of appeal, but may not raise a new objection. Right. So you can add certain grounds and say, well, okay, that was intention, but it's deductible in terms of Section 11A. The time of disposal is there. But at this point, they could have said the process has not unconditionally accrued at that point, because it's not, you're adding a grounds of objection, but you're more elaborating on it than you're really putting a new grounds. All right. All of the rest have been unchanged, and this is also alternative dispute resolution. So what's the process? Request for information. You respond to request for information. I actually want to start before that. What's the process when you look at the whole thing? The process before that is by the time you do an ITR 40, this is, you've done a first provisional payment for that year. You've done a second provisional payment for that year. You've done your financial statement calculation for that year. You've considered 6 months after year and whether you're going to do a top-up payment for that. Then you do the ITR 14. That's the 5th time you've done a proper tax calculation. You're obligated with each of those 5 times to do a proper tax calculation for that company. You've had 5 times a bite at that cherry. Do it properly. Get all your documentation right. Then it gets submitted. Because SARS knows you've had an obligatory 5 times look at your tax calculation. If they find a mistake, they're going to nail you with the understatement penalties. Okay, so if you didn't done that properly, you're okay. So now SARS looks at it. Then the process starts. Request for information. If you've done that, there are 5 steps, particularly the last one, properly, you've got to tax back everything, you respond to request for information. You've got your tax positions, hopefully you blow them away. So that step, you put more effort into that. So the more effort you put into the planning phase, the submission phase, the less you're going to have a problem afterwards. When you get a request for information, if you start running around looking for information at the RFI phase, you've not done your work before that properly. Then you get RFI SARS doesn't like something, escalates to an audit. Out of the audit, more information. It escalates to request of audit findings. You then respond to request for audit findings, you respond to it properly. At that point, when you think, and there's a very, very technical matter like in the Thistle Trust, like in the coronation management side, you go to senior counsel as early as possible if you think this matter is going to progress to court. Okay, because remember, we don't fight in court. Senior counsel fights the matter in court. From there, that's the objection. And the objection, SARS denies or the proof. Then you say, I'm going to appeal it, but you tick the box and say, I'm going to go for the alternative dispute resolution process. Under the alternative dispute resolution process, you and SARS gets together. There's a facilitator. Quite interesting here because the rules actually talks about who the facilitator must be It may be a SARS official, but sometimes it isn't. Generally nowadays it is a SARS official, but you can say, no, I don't want a SARS official. If the numbers are big enough, sometimes it could be a retired judge. I've been in ADR sessions where the best ones that you get is a retired judge that's got the ear of both SARS, and he's got the gravitas that people listen to them. Okay. So he's the facilitator, not a mediator. So he tries to facilitate the party, and there are certain rules on how he must operate. But this is interesting one here. In paragraph 21, and consider this as you start an ADR. SARS, the appellant, and the facilitator may agree at the commencement of the proceedings that if no agreement or settlement is ultimately reached between the parties, the facilitator may make a written recommendation at the conclusion of the proceedings. If you have a retired judge or somebody with gravitas that's been around the block, often you get SARS officials at head office that are highly skilled in what they do, and objective. They are really excellent people at SARS who can look at it objectively, that knows this thing is going to succeed in court, this not. Then you can see at the beginning, say, guys, we're going to go through this process, but Mr. Facilitator, at the beginning, what we'd like you to do is to actually make a recommendation. And that's a recommendation. That is, you're not bound by it, but then the parties can actually say, okay, that was good. Because the rest is, you just ask probing questions, you just make sure that people play fair. All right. If you don't reach a conclusion on alternative dispute resolution, then you go up to court. And I'm not going to deal with court because at that stage, you've now given all, that's where I generally help clients up to ADR process. And 9 times out of 10, we're able to even more, 90% of the 99% of the time, if we've done our work properly up to that point in time, we don't go to court. I've been doing this for 30 years. There is only 2 issues that we've gone through the process, and at the end of the day, it went to court. And neither of those were something that you could do as you look through the ITR 14 or anything. It's very, very technical matters, and was industry matters. So if you really put the effort, and I'm a great proponent of putting the effort into it beforehand. So I want to thank you for your extended time. I want to thank you for staying for the extra 15 minutes. I hope you enjoy the tax chat. Please, if you want the CPD certificates, please send an email to Natasha. She will then send you the CPD certificates for your attendance of this. And then also you'll get copies of these slides. And please also, if there are certain topics you want us to talk about, please send it to us. Then we can consider it. We're taking certain topics that we think is relevant and that is hot off the press. But send us some topics. If there's something that you want to talk to us, then we would like to just put that onto our list. Thank you, and I'll see you on the 25th of April. Enjoy your day, and thank you very much. Goodbye.